thank you everybody for turning out. It's kind of amazing when people turn out for something as boring as tax. So thank you so much. I also want to give a quick shout out to Cal State Northridge's Volunteer Income Tax Assistance Center. That is hosting this workshop. And I just want to let you know, if you or someone you know makes $60,000 a year or less, that person can get free tax preparation, tax resolution, like if you get a scary letter from the IRS, and financial coaching at CSUN's VITA Center. So if you or someone you know makes under $60,000 a year and wants these services, you can email them here, you can call them, you can slide in their DMs. And but enough about, I am a freelance After Effects artist, a full-time freelance MoGraph artist. I've been in the industry for over 20 years. Jenny and I go way back. And I also have a master's degree in taxation and a tax consultation business. We are very old, Jenny. And you know, so I give hourly consultations and these workshops to artists, regular folks, really people who have questions but are too afraid or intimidated to ask, or don't know who to ask, or are intimidated by their accountant. So, you know, since I've been freelance my entire life, I started learning about tax and business and money from much probably the same way that all of you you all learned, which is like from other artists and your peers. And you know, like you, I'm sure, I got a lot of very contradictory information. Even like some tax preparers are like giving you what seems like contradictory information. So I went back to school to get a master's degree in this stuff so I could really understand what the law actually says, what you actually can do, what you actually can write off. And I'm here to explain it to you. So the first thing I want to go into, and Jenny, I will make this short and sweet, is a real quick primer, because I want to make sure we're all on the same page and know what we're all talking about. So we're talking about the taxes that you pay from your wages or from your self-employment or freelance income. So this is all service income. And if you look at your pay stub, you'll notice that there's like 4 main buckets of taxes we pay. That's federal personal income tax, California personal income tax, payroll taxes, which has a lot of names, like Social Security and Medicare are the main federal payroll taxes. And then in California, you pay state disability insurance. Now, by the way, you and your employer split Social Security and Medicare. So you kick in 7.65% of your paycheck, and your employer actually kicks in 7.65% as well. And that income taxes, federal and California income taxes, those are progressive taxes, whereas those payroll taxes and SDI are flat taxes. And I think with a flat tax, you can pretty much understand what that means. I will, but I'm going to draw it for you just in case. So, for example, a flat tax, say this square represents your entire income. Social Security and Medicare, which is 7.65%, is a flat tax, although actually for higher income earners, like above 150, 160, those taxes don't get applied anymore. But let's just pretend we don't make that much. So that's 7.65. That's a flat tax. That's easy peasy, right? What about a progressive tax? So I'm going to show you how the federal income tax works. So the first thing you get is you get this kind of gimme from the government. You can take off either the standard deduction or itemized deductions and not pay any tax on that. So just subtract that from your income, pay 0% tax on that. Next, you are going to cut the first tranche of your income, and all of these like thresholds, or you can Google them. I'm not memorizing that for you. You take that first tranche and you take 10% of that as your federal income tax. You take the next tranche, you pay 12% on that. And then you go on and on until you either run out of income or you get to our top tax bracket, which is the 37% tax bracket. And I want to show you this because some people get confused about what going up into the next tax bracket means. It doesn't mean that, like, if you moved up into like the 22% tax bracket, it doesn't mean that now all of your income gets taxed at 22%. That is not how that works. If you end up making more money, say you went up into the next tax bracket of like 24, it's only the next dollar that gets that extra higher tax. Your previous dollars you've already earned have been taxed at a lower rate. So that's how that works. All right, let's move on.
That's interesting because I didn't really know that.
Yeah, I mean,
you only get like taxed a little bit. I mean, you get taxed how much? Like, let's say, I mean, we're all not in the 37% range, but once you hit that threshold is when you start to get taxed 37%.
Exactly. That next dollar. That's why it's called marginal tax rate. Like you pass the margin and you keep on going. But everything that already happened, all the income you already earned is like, that's already been taxed at like a lower rate and that stays there.
Cool.
So yeah, that's something important that I need y'all to learn, because some people are like, I don't want to go into the next tax bracket. I don't want to make more money. No, make more money. Do it. So now let's talk about deductions. Jenny, you had like kind of a general question about like what?
Yeah. So, like my biggest issue with taxes is paying them, obviously, right? Yeah. But I want to know like how to pay less of it, but obviously in a legal way. So like, I want to know, we all work from home. Can I write off my office? Can I write off internet, my cell phone, food, gas? I want to know about everything I can write off. I want to know like, hey, charities, nonprofits, GoFundMe. I'm always giving, $20 to your friend's film idea or whatever. Can I write those off if it's in like the MoGraph industry? And then, of course, travel expenses. We all love to travel. But let's say you meet somebody that works in the industry, like at a bar or a restaurant. Can you write off that tax if you're like talking to them about MoGraph? I don't know. Is that like a far stretch?
Well, let's dive in. Okay, so you just gave me a very big list of expenses. Some of them were personal and some of them were business related. So first of all, in general, I'm going to be like giving you definitions that sound really like dumb and basic, but you know what? Someone's going to benefit from this definition. So, sorry, let me switch over to here. So deductions. First of all, let me define that a deduction is an amount that you can subtract from your income on your tax return that Congress has allowed you to. So the less income you declare, the less taxes you pay. There are two broad categories of deductions that I'm going to talk about. There's what I call the everyone deductions that is available to everyone regardless of what business you're in, and that's standardized. That's either the standard deduction or the itemized deduction. I'm going to talk about them in just a second. And then the fun, like business related deductions, in our case, MoGraph related deductions. So we're going to talk about that. So first, let's talk about these everyone deductions. So everyone can choose between the standard deduction, which is an amount based on your filing status, single, married, filing jointly, head of household, or you can choose to add up some itemized deductions. And itemized deductions are basically, they make up a basket of specific expenses that Congress has decided is a good idea to allow you to take. And basically you take that amount and then you chop it off your income, like I did on that progressive tax picture. So what's in this itemized basket? Turns out not much. This honestly mostly benefits homeowners. So people with mortgages, listen up. you can take your mortgage interest for loans up to $750,000, by the way. So if you have a loan higher than that, you can only take the interest on $750,000 of that. State and local tax is what SALT stands for. So we're talking about your California income taxes, your property taxes, that like $50 that represents tax on your DMV payments. But you cap out at $10,000. So if you had $30,000 of state and local taxes, too bad, you get $10,000. If you and your spouse had $50,000 of state and local taxes, too bad, $10,000. Medical expenses, that's also an itemized deduction. It's subject to some thresholds that are pretty hard to get over. So ask me at the Q&A. We are having a Q&A, by the way. Ask me at the Q&A if you want me to go into how you can do that. And then Jenny asked about charitable deductions. So everything's got a rule in the Internal Revenue Code. To be able to deduct a contribution to a charity, that charity has to be like a bona fide real charity, like a 501c3. If you go to the irs.gov website, they actually have a place where you can look up charities and see that they're like legit. So, so therefore, your friend's GoFundMe is probably not a charity, because to be a 501c3, there's like so much freaking paperwork you have to go through. So when you're donating to your friend's GoFundMe, you're giving them a gift. And then there's going to be some random stuff that you like. I'm pretty sure you're not going to have, like, I don't know, like gambling losses to the extent of gambling gains and stuff like that. So so basically, you look at your standard deduction based on your filing status, or you look at your basket of itemized deductions and you just pick the biggest one. You can go back and forth every year, just picking the biggest one. Mm-hmm. Now, I want to talk about two more deductions that you can take. These are called above the line expenses. So you don't have to go through that like itemized deduction versus standard deduction rigmarole. These just, you chop directly off of your income if you pass the tests. So the first one is student loan interest. If you're paying interest on your student loan, you can take up to $2,500 if your income is $85,000 if you're single or less, $175,000 or less, married filing jointly. Another one, I don't know if some of you like, there's a lot of people in the industry who like teach one class, part-time at like Noman or Portfolio Center or whatever. And their tax preparers will encourage them to take this $300 educator expense deduction. Don't do that, because that is only for like true educators who work 900 or more hours a year. So it's a little bit of a red flag if you're not like a true educator. Now, and that is the everyone deductions. So the next thing that I want to talk about are the fun deductions, which is the ones that are related to our business. So first of all, Jenny, tell me, everyone here is they're on W-2, right? They're on payroll? Mm-hmm, mm-hmm, mm-hmm. Okay, so the first thing I want to tell you is that if you receive your income as an employee that is on payroll on W-2, you cannot deduct your business expenses on your federal tax return because of the Tax Cuts and Jobs Act of 2017. You can, however, deduct it on your California tax return because California is non-conforming in dress code, hair color, tax code. So yeah, it won't save you as much money, but maybe it'll save you like $50, $100, $1,000, depending on how many expenses you have.
So Claudia, just to confirm, you can't write it off on your federal, but you can write it off on your California. But when does that tax and Job Act dissolve so that we can write it?
So that is the good news that I have for you, is that because of the way the Tax Cuts and Jobs Act was written, it was written like in a revenue neutral way, I think, so it wouldn't have to go through like an extra step of appropriations. So basically that limitation on what is called the 2% AGI floor unreimbursed employee expenses deduction, that comes back actually. So now you're able to take it in 2026, which is right around the corner. So so even though you can't take it right now on your federal tax return, I want to tell you about it because you will be able to in a few years.
Okay.
So let me show. First, I want to show you how that works though, because it's not like, thank you, Morgan. Morgan says amazing graphics. This is all memes all the time. So let me see. Let me draw. I want to draw another picture. So first of all, what has to happen is you need to you can't just like subtract it from your income directly, like student interest. You have to go through the itemization rigmarole again. So in 2026, this is going to be added to that itemized deduction bucket. It's going to be one more thing you can stick in that bucket. However, there's like one more little hurdle you have to go through, and which says that all of your unreimbursed employee expenses, that is what you spent as an employee but didn't get reimbursed back from your employer, it has to go over a 2% AGI floor. What in tarnation does that mean? So AGI stands for adjusted gross income. Adjusted gross income is basically income plus or minus some like tweaks that, I don't really want to go into, but it's a close enough approximation to your income. So AGI income, kind of like close enough. So you take your income, say you make $100,000. You multiply that by 2% for the visual learners. Here's 2% of your AGI. And now let's do a little word problem. If your business expenses are $5,000, then first you have to take your AGI floor. So here's your business expenses right here. You have to chop off that $2,000, and what's left over is what is actually deductible. So if you want to do this by the numbers, it's 5,000 minus your floor of 2% AGI. 3,000 is all that's allowable. And so you take that $3,000, you throw it in your itemized deduction bucket, and hopefully that gets you over the finish line. So, and by the way, that's what you've already been doing on your California tax return, like since the Tax Cuts and Jobs Act passed. And I have to also point out, if you have a side gig, but that side gig also pays you as an employee on W-2, then you are, for tax purposes, also considered their employee, not a freelancer for them. And it's the same thing. You have to go through this like 2% AGI rigmarole.
So even though you're like, let's say you do an illustration for the New Yorker and you happen to do a W-2, you still can't deduct those other deducted, like you can't deduct your internet or cell phone client calls, that kind of stuff, if you're on a W-2, is what you're saying.
You have to go through that 2% of AGI, itemization thing. Yeah, if you are paid on W-2, basically W-2 equals employee for tax purposes, full stop. But if you're paid on 1099, then that 1099 basically makes you a small business, and then you can deduct the expenses that small business spent directly, like just subtract it. All right, next. So what are these expenses? Let's find out. First, here's another Captain Obvious definition. So first, let's define what a business expense is. For business expense to be deductible, the IRS had to come up with, or rather Congress had to come up with a necessarily overbroad definition that covers like every industry, every expense. So it needs to be, a business expense needs to be ordinary and necessary to be deductible. I'm telling you this definition because I'm not going to cover every single thing that you can think of or that you may need. So you can apply these tools yourself. So it's ordinary in your industry. So like this Wacom pen is ordinary in my industry, but if I was like a traveling nurse, not so much. And it's necessary. Without this Wacom tablet and pen, I would not be able to make money. Like I really need this to make money. Bye, Tina. So that is a definition, ordinary and necessary. Remember that if you have a doubt about whether something is deductible for your business.
Let's say you're having like a business dinner. It would be ordinary because it's food, and it's necessary because you're meeting a client. Would that fall under?
So there are some business deductions that are available to pretty much every business. And so I'm going to skip down to the number 3 there, meals. Meals are only 50% deductible. However, Congress has decided that that you are getting, that you can only take 50% of the deduction because you are benefiting personally from 50% of it at least, which is, eating. But when you have a business meal with a client, you have to document. Think of like who, what, when, where, why, right? Like who was there? What were you doing? When and where did this happen? Why did you meet? Would be super great if you were discussing a specific project or if that meeting led to a specific paying project. So make sure you document that somewhere. I personally just write it straight down on the itemized receipt itself and then snap a picture and throw it up into my bookkeeping software, or you can just email it to yourself. Everyone works from home. So you are allowed the home office deduction. What that is you take a percentage, the percentage of your home, percentage by square footage, that is used continuously and exclusively for working. And then you take that percentage and you multiply, if you're a renter, your rent, your rental insurance, if you own your home, your mortgage, your property tax, your homeowner's insurance, and for everyone, your utilities, your general maintenance, cleaning, and you can take that as your home office deduction. Now, if you're only using your home office for your side gig, be reasonable, because if you did a side gig for like, the only side gig you did was like 2 weeks out of the year, like, can you really justify taking the home office deduction for the entire year? Now, oh, and I want to mention too, if you're getting, some companies give a stipend, like a home office stipend or whatever. If you're getting reimbursed by your company, like you can't double dip. So you can only because once they've reimbursed you, that's their deduction to take, not yours. So you can only deduct what you've paid for. Now, if you drive, like if you drove to that client meeting, Jenny, so your auto expenses, you're supposed to track every single place you go and what its purpose was. Basically, the entire tax paying exercise, it's not really about paying taxes so much as it is about leaving yourself like a very juicy paper trail. So yeah, you have your mileage log, and you can do the same thing, like similar to the home office deduction, where like you take the business percentage, so like your business miles divided by your total miles. and you multiply all your gas, all your oil changes, maintenance, etc. Or what I like to do is I just count my business miles, and then I just take the standard mileage deduction, which this year is 65.5 cents per mile. It's just a lot easier, and it usually, I would say 75% of the time, comes out better. Continuing education. So if you take like, you take a side class in rigging, or you download a tutorial, as long as it maintains and improves your skills in your current trade. So if you were to like go to school to, I don't know, to get a master's in taxation, you could not deduct that from your motion graphics work. Gifts, like to clients, $25 per recipient limit. You can spend more, but you can only take 25.
So talking about continuing education, so all of that mid-journey that people are experimenting with, all those hours, the monthly fee, whatever, we can write that off.
So I wouldn't call that continuing education, but you could definitely, I mean, that's a tool you're using. So there's a few buckets you could put that in, like you could call it a subscription. You could call it like a software subscription. So your Midjourney subscription, absolutely, you because it's ordinary. Everyone in the industry is using it. Is it necessary? Yeah, it is. It really is. So so for sure. Yeah. So these deductions that I put up on the screen now, these are more specific to motion graphics, to what we do. This is an unfortunate reality, but there is such an element of fun in a lot of what we do, that the lines are kind of blurred between like personal and business sometimes. So, if there is like a doubt in your head, like, ooh, am I really using Netflix only as my, for research? Be reasonable and prorate, take a percentage. It's always good for a lot of these things, especially if you go to the movies or you download a video game. It's good to take notes. If it's best of like, if you can relate these things to a specific project, like, oh, I downloaded this because, I wanted it as reference for project ABC. And so with that in mind, you can, your subscriptions, your Netflixes and your Hulus, those are your reference libraries. Disney Plus, etc. Any trade memberships or union fees. So in the research bucket, you've got your movie theater tickets, you've got your video games. You can, since you're working from home and you definitely need this stuff, your internet and your cell phone. I want to call out, internet and cell phone are not utilities. They do not go in home office deduction. They are their own separate thing. So internet, you can take a reasonable percentage of that because you are not using it 100% for work. Your cell phone, same thing, unless you have like a dedicated phone for for business only. Christine?
Sorry, so I actually am not like an artist actively. I'm adjacent as a production side. Are these expenses that actually like they help us understand generally like how things flow? Are these a little bit applicable also for that end?
Are you, again, let's go back to the ordinary and necessary question. Would you be at a substantial disadvantage if you didn't, in your industry, if you didn't have these things?
Some of them for sure, but not all.
Yeah, and again, this is one of
Fair
those
enough.
like, be reasonable, prorate when there's a doubt, or try to this is one of those things where you have to ask yourself, how does this relate to whatever project I'm working on or whatever project I want to work on or want to pitch?
Mm-hmm. I mean, like if you are producing the next Buck game and you need to know how games work,
yes,
yeah, you should absolutely buy those games, right?
Research. Yeah, exactly.
Mm-hmm.
Yeah, you can't produce a video game without knowing what a video game looks like. So yeah.
Fair enough.
Yeah. But like, for example, okay, so I have Netflix, but I watch these like Jenny, don't kill me. I watch horrible like crime dramas. And yeah, like I can't really justify, you know, like if I just had Netflix only to watch procedural crime dramas, I really could not justify my Netflix unless, you know, I was working in episodics. So
Totally.
let's see what else. Okay, software, that's an obvious one. Travel. Yeah. Okay. So this is a big one because there are very, very specific rules about travel, and none of us get them right. Like literally none of us. So first of all, your travel expenses are going to be your airfare, your train fare, car rental, hotel, meals, incidentals. By the way, meals when you're traveling are still 50% deductible only. So just like, I don't know, you may as well just like put them in a separate bucket or something. Again, notes, contemporaneous notes. Why are you there? These are the rules. They're a little bit janky. So if the travel is more than 50% personal, so mostly personal, it's none of this airfare, car hire, hotel, etc. None of that is deductible, but you can deduct these specific things that were business, such as like if you went to a conference, or if you flew out to Bali to meet a client for a day, but you stayed there like 20 days. Now, if it's more than 50% business, so mostly business, say your business was 65%, excuse me, your travel was 65% business, then the percentage, then that 65% you would apply to the airfare, the car hire, the hotel, etc. Now, this is a very specific, interesting little rule. If it's foreign travel, it's less than a week, but more, or 75% or more business related, you take the whole thing. The whole thing is a business expense. So the moral of the story is count your days and what you're doing. Jenny, you had a question about side hustles, didn't you?
I did. So I want to talk about side hustles because, like, I know, you know, if for me, you know, like, let's say you created something on the side, like, you know, I've been doing a bunch of Midjourney stuff and I made a bunch of posters that looked pretty cool. So I'm going to put it up on some website, Etsy, whatever. None of them are selling, but I did put in like hours and hours of work. Can I write off all the work, the hourly work that I put in? Let's say I pay myself $100 an hour or whatever I want to pay. Can I write that off as a loss?
So first of all, you paying yourself, if you're just like a sole proprietor or even a single member LLC, is not a thing. You paying someone else is. So, so the hours that you spend laboring as a sole proprietor are, those are gone, man. Sorry, but you know, whatever you spend in actual money are true expenses, even if you're not making money yet. So, but first I want to, again, define side hustles. This is an easy one. Basically, if you, so an independent contractor, a freelancer, a small business owner, someone with a side hustle, it all means the same thing if you are paid either just in a lump sum without the taxes taken out, and or you get a 1099-NEC or maybe a 1099-K from your Etsy. If you get paid on 1099, you're a contractor for tax purposes. If you get a W-2, you're an employee. So I just want to make that, drive that point in for tax purposes. And obviously there are pros and cons to both. So let's talk about the cons. The cons, basically, you are not an employee. So you don't have employee protections like, unlawful termination, et cetera, you have a business-to-business relationship. So act accordingly. Make sure you get a contract. If you are on 1099 with someone, they are your client, not your employer. And, you know, make sure that your contract covers every eventuality that will be detrimental to you if it is not in writing. Like, for example, a client at the very last minute says, I need you to work over the weekend to get this out on Monday. Well, wouldn't it be great if your contract that they signed already said that that will be $1,000 an hour? As opposed to like getting to that like Friday night and being like, oh, can I get $1,000 an hour maybe, please? And having to like, basically, you know, there's a lot more risk in being a contractor, but a lot more reward as well. Another thing that, another con is that you are also responsible for your payroll taxes, both the employer side and the employee side. So you don't just pay 7.65%. You pay 15.3% of self-employment tax on top of your income tax, because you're both employer and employee. But there are a lot of pros. You can, the main one is less taxes. You can directly deduct your business expenses, just like subtract them right off of your income. You don't have to go through that 2% AGI itemization. You don't have to wait till 2026 if you're paid on 1099. I do want to note though, remember that you are just deducting the expenses for that gig, not for your like life. And you only pay income and self-employment tax on the profit, which is the income minus the expenses. So that's why, you know, it's more beneficial to just like subtract those expenses directly from that income. In through 2025, also because of the Tax Cuts and Jobs Act, you get small businesses get a 20% qualified business income small business deduction. So of that profit, you for most incomes below like 100, I can't remember if it's like 130, 150, something like that, you get 20% off of your profit that you don't have to pay taxes on. And if you choose, you can also open a SEP IRA and put 20%, another 20% of your profit into a retirement account and not pay taxes on that 20% either. So a lot of goodies for independent contractors. Oh, whoops, hold on. And however, there are two things I want to warn you about. If you're going to make a lot of money in your side gig, remember that you're just getting paid lump sum without the taxes taken out, because you are the one who's supposed to take the taxes out. And so if you make a good sum on the side, you're either going to have to pay quarterly estimated taxes, or you're going to have to ask your main job to increase withholding. The alternative to that is just wait until the end of the year and see what happens. You'll owe extra tax, and if you owe more than 100 or 110% of what you made last. If you make more than 100 to 110% of what you made last year, then you're gonna owe extra tax. The penalty for underpaid estimated taxes is 3% plus the federal funds rate, APR. After April 15th, whatever's left over that you didn't pay, you're gonna have to pay 0.5% per month. So just that can be big or small depending on how much you owe. Just don't say I didn't warn you. And the other thing that I think kind of addresses Jenny's question is there's something called the hobby loss rule. And this really applies to side gigs, especially if you have like a main job that gives you the bulk of your income. And that is that if you have a business and it goes into loss, that is, you spend more than you make in the business, 3 or more years out of any 5 concurrent years, if the IRS, takes a look at it and audits it, then it can declare that business a hobby. And hobbies can't deduct any business expenses. However, they still have to pay tax on the income they make. So, going into loss 3 or more years out of any 5 concurrent years, that's a thing to watch out for. Oh, Jenny, weren't you wanted to talk about tax credits, right?
I do, because there's so many tax credits out there that I don't know which ones we're allowed to take. So I had some questions about that.
So there's like a ton of tax. Oh, first of all, another definition. I just want to make sure everyone knows that a tax credit is like a dollar for dollar reduction on your tax. So like $100 tax credit means that you pay $100 less in tax, as opposed to a deduction, what we've been talking about this whole time. Deductions, they reduce your income. So think of a deduction as like more like a coupon on your purchases. And so what we're talking about now is tax credits. Credits are passed by Congress in order to kind of fulfill some sort of like greater economic or social goal in general. There are 2 kinds: there's refundable and non-refundable credits. So a refundable credit, if you paid $100 in tax and you got a $200 credit that was refundable, you would get the full $200 back, even though you only paid $100. The non-refundable credits, which is like most credits, you would just get like $100 back, and that extra 100 would just go nowhere. So like I said, there are a ton of credits. So I'm just gonna like kind of call these out, and if you want me to go into more depth, we can talk about them at the Q&A. But the biggest one that is also like quite bipartisan is the earned income tax credit. And that's like it's I mean, the maximum earned income is like 63,000 and change, but that's like that's like a family making, that's a family like with like 4 kids or something, making like $12,000 might get, close to that $7,000 maximum EITC. But yeah, there are differing amounts depending on how much you make there. Another credit that is a little more accessible is the child and dependent tax credit. That phase out starts at incomes of $200,000 if you're single, or $400,000 AGI if you're married filing jointly. And with that credit, you get up to $2,000 per child under 18. And it's partially refundable up to $1,500. You can also get a credit for a non-child other dependent, like aging parents, for example. If you're supporting them, they don't even have to live with you either. They can live either in their own house in the U.S., Canada, or Mexico.
I have a quick question.
Yeah.
So if you are taking care of your aging parent, they cannot claim themselves as a dependent. Right. That's the only loophole here, right? You have to be able to claim them.
Yeah, they have to be on board. So yeah, I mean, and they'll really only be on board if like you're truly taking care of them. So
totally.
And yeah, so there's education credits. So there's a $2,500 American Opportunity Tax Credit, but that's like for the first 4 years of college. That's not really going to apply to anyone here. And you have to get education credits. You have to make basically the phase out starts at like $80,000 for single taxpayers and $160,000 married filing jointly. But there's the $2,000 LLC lifetime learning credit, which is just that. It's for your entire life. So if you go and you take like one class at UCLA Extension or at community college in any topic whatsoever, if you meet the income limits, and as long as you get a 1098-T form from this accredited college, you can get up to $2,000 of a tax credit. for tuition. There's adoption credits. There's a savers credit if you make under 73,000 and you contribute to like a 401k or an IRA. So there's tons of credits out there. California, not to be outdone, also has credits. There's lower income thresholds for the EITC. I'm sorry, I didn't talk about the the dependent care credit. So if you're paying for childcare, then you're most likely going to get some amount of dependent care credit for paying for childcare. If you're married filing jointly, both parents must be working, because the point of this credit is to help out working parents.
What about like summer camps, art classes? Do those count, or do they have to be like nanny or related? You know what I mean?
So as long as they're day camps, as long as they're not overnight camps, then yes, because the idea is like you drop them off, you go to work, and then you come back and pick them up. Yeah, exactly. Yeah, exactly. Day camps, totally fine. So California has these. California also has the dependent care credit, and it's calculated similar to the way the IRS calculates it. So you're going to get that. You're going to basically get a double boost there. I don't know if anyone's making $50,000 a year single, but you can get a renter's credit in California if you rent. So that brings us to the part where I actually give you good information about not paying taxes. So I want to tell you how to legally avoid tax for ordinary working schlubs like us. There aren't a lot of levers we can legally pull. The main ones I like basically involve just like retirement. So all of you, or most of you, have access to 401k, right? So what I want to tell you right now is max it out. You can put up to $22,500 this year of your own wages into this 401k account. And so basically you get that 22,500 doesn't get personal income tax on it. And you can get a nest egg growing tax-free and compounding until age 59 and a half. So make sure you max that out. I don't know if anyone's over 50 or over, but in that case, you can put in $30,000. So when you hit 50, you can put an extra boost. Let's see what else. If you want to go an extra step further, you can think about a traditional or a Roth IRA. That's you can put $6,500 or $7,500 if you're 50 and over that has to be funded by April 15th of the following year. My big like advice to you is do not put that money in now. Wait until next year. Wait until the year is over. You know exactly how much your income is, because there are like so many rules and phase outs. Like for example, if you're single and make basically over $153,000, you cannot put money into a Roth. If you have contributed to a 401k and you make over $73,000, you can't deduct your traditional IRA. So there's like insane rules. Put in all your income into your software or talk to your tax preparer and, ask them, what should I put where to maximize my tax situation? Because a traditional IRA and a 401k saves you taxes today. So you don't pay tax on whatever you put in, but you pay tax when it comes out at retirement. A Roth IRA does not save you tax today, but when it comes out at retirement, it is tax-free.
I have a question, Claudia.
Yeah.
Can I put $22,500 in my 401k plus $6,500 in my Roth IRA, or are you saying a total of $22,500?
So the 401k is just $22,500. And then in addition, if you are under the Roth income limits, you can put in $6,500 into your Roth. If you are over that limit, you can put that money instead into a traditional IRA However, it was not deductible because you made over $73,000. So then you immediately do a backdoor Roth. Yeah. So there's a lot of little like little hacks. And I know it's a little bit scary sometimes to like think about putting all this money away, locking it away for like what seems like forever for all you youngsters out there. I wanna just point out that this is not at all advisable. But if you are in a pinch, your 401k, most 401k plans, you'd have to ask your administrator, allow you to borrow the lower of 50% of its total value or $50,000. You have to put the money back in within 5 years with interest. And you can avoid, and that way you avoid this early withdrawal penalty. And you wouldn't pay tax on it because it was a loan. And what else? You can also, from an IRA, you can avoid that 10% penalty, but you still have to pay the tax due. If you take out money from your IRAs for higher education, you can take up to $10,000 if you're a first-time home buyer, or to pay for health insurance if you're unemployed. The Roth IRA, I want to point this out because I don't know why more people don't know this, but you can always take out the principal, not the growth, without penalty at any time. So say, Jenny, you put in $5,000 this year into your Roth. Next year, it's worth $7,000 because it grew. You need that $5,000. You can pull it out. Just don't pull out the extra.
No penalty?
Because you already paid tax on it. Yeah.
Oh.
Yeah.
But that's just for your Roth, not your 401k.
That's for your Roth IRA.
Got
Yeah.
it.
And actually, there is a thing called a Roth 401k. That is not the same rule there. So it's just your Roth IRA. Yeah, sorry, Christine. The Roth 401k, it's like you do pay tax on it. You don't pay the full amount of tax. It's like this weird prorated thing that happens that is a little bit difficult to understand. Bonus topic, either an educational savings account or a 529 account. You can start one for your kids, and it's called an educational savings account. And it also functions a little bit like a Roth IRA, where it doesn't save you taxes today, but it can compound tax-free. You invest the funds and it grows tax-free. And when you pull it out, either for your child's K through 12 or college, you don't pay tax on it as long as you use it for their education. And the last thing I want to talk about is HSAs. So Jenny, you had asked me about this because you said that you were curious about what the hell this thing actually is.
I feel like, Buck offers HSA, but there's always a confusion on what it is, basically.
It's very confusing. So I think the best way to think about it is that is with this meme. It works in conjunction with a high deductible health plan. You cannot use fund your HSA, health savings account, without having a high deductible health plan. So a high deductible health plan is exactly what it sounds like. It's like a bare bones health plan that I think legally it's required to offer to give you like a free annual checkup and like a flu vaccine. But everything else you just pay out of pocket until you hit that high deductible. I, by the way, have an HSA and an HDHP. I think my deductible is like $5,000. So I'm going to pay $5,000 for medical expenses. And then after that, it kicks in like a regular health plan. So this is really great if you really don't go to the doctor that much, you're pretty young or healthy. The plans, especially in California, I've noticed are usually considerably cheaper than a regular HMO or PPO. And so you open your HDHP and then you go over and you get an HSA, a health savings account. And if you're single, you can put in $3,850. If you for family plan, it's like $7,750. You max out your HSA, and then you draw from it for your medical expenses. You can use it for basically everything medical related except premiums. So you can use it for your doctor's visits. I bought my LASIK with it. And you can also, and actually I also I buy tampons, sunscreen. There's a lot of over-the-counter stuff that you can buy with your HSA. You can find lists of it online. So yeah, it's pretty great. And everything that you take, so that amount that you put in, that $3,850 if you're single, for example, is not taxable on your federal return. California, for some bananas reason, still taxes your HSA amounts, but the amount that you put in should not be taxable. It's allowed to grow tax free until retirement, when you can pull it out, or you can pull it out anytime to pay for medical expenses without paying tax on it. There is an even steeper withdrawal penalty though of 20%.
So just so I'm clear, let's say I'm single, then I can put up to $3,850 in the savings account that grows tax free. So that kind of comes out of my paycheck before taxes.
Mm-hmm.
And it's just something, it's almost like a savings account, a retirement account, really.
Exactly.
So all the health insurance money that you're putting in, if you are young and healthy, you don't go to the emergency room, et cetera, you can eventually pull that out as part of your retirement when you're 65 or whatever.
So just to be clear, the health insurance premiums you pay separately than the amount that you put into the HSA account. So you're paying a monthly premium for an HDH for a high deductible health plan.
Oh, God.
And then I know this is why it's so confusing.
Right.
And then separately, you have this account that you can pay for your dental visits, your office, your doctor visits, etc.
Yeah. And Brian Wan was telling me that if you do go this route, they give you a credit card, and then you use that credit card to buy whatever you need health related, sunscreen, eye drops, tampons, or whatever. That way it's all itemized on that card.
Yeah. Okay. Exactly. Yeah. And you are supposed to, save the receipts, blah, blah, blah. But yeah, I mean, that'll be itemized. And usually, honestly, when you go to the CVS or whatever, there's going to be a little H or F or H or something, because it also works for FSAs, next to the items that are deductible. So even if you forget to use your credit card, you can reimburse yourself the exact amount for that HSA eligible purchase.
I always tell people, if you're young and healthy, go for the lowest, HMO, Kaiser, do a HSA. You don't really need a PPO. You're just spending a ton of money, really.
Exactly.
Yeah.
And the HSAs they are the cheapest option in California. So I would definitely do that. Yeah. I mean, you're in a different boat. You have a kid. So I hear those things are expensive.
She just broke her arm.
Yeah.
I mean, not just, but in October, and then she had to go to multiple emergency rooms.
Oh,
and then had I had this, I would have probably been a bit screwed. But
you would have paid.
I would have paid
you would have paid $7,750. Yeah.
Yeah. Totally.
Or whatever your deductible is.
Yeah. Which interestingly, my PPO, I ended up paying a couple $1,000s anyways for the ambulance and this and this and that. So you know what? Maybe this would have been better for me.
Yeah. And it's one of those things that, I mean, you have to have it for a few. You can always choose something else too. I've had mine for years, and I literally spend $200 to $400 a year. The rest is just in index funds, just stacking. So
it's amazing.
Yeah, it's great. We're at the end here.
Well, I think we'll wrap it up then. We have this recorded, so I will send this out to everybody. Thank you, Claudia, so much. This was so informative.
Thank you, everybody.
Thank you.
Thank you so much.
And seriously, please do me a big favor. If you do know anyone that makes under $60,000 a year, like please send them to Cal State University at Northridge. They do really, really great work. They brought this workshop to you.
Thank you to Cal State Northridge.
All right.
Awesome. Thanks, everybody.
Bye.
Thank you.
Bye.